If you have $100,000 sitting in a plain index fund this morning, about 42,000 of it is riding on one bet. Not 42 companies, one bet. And this summer, three of the biggest banks in America quietly tried to get out of that same bet and could not find anybody willing to take it off their hands. Almost nobody reported it. Here's what happened. Oracle borrowed $38 billion dollars to build data centers in Texas and Wisconsin. JP Morgan, Morgan Stanley, and a Japanese bank called SMBC put the loan together. That part is easy. The hard part comes next. A bank does not keep a loan that big. It cuts the loan into pieces and sells the pieces to other lenders. That is the business. That is how it has always worked. They have been trying to sell those pieces for more than 6 months. They cannot. Some of them are now offering their pieces at a discount, which is banker language for, please, somebody, take this. Hold on to that because it goes somewhere. The banks said no. Somebody, eventually, said yes. And who said yes is the whole story. I have a screen I keep open while I dig into things like this, and it is the reason I caught this one at all. I will come back to it. First, let me explain what it means when a bank says no to good business. Every bank has an internal rule about how much it can lend to one industry. Think of it like your doctor telling you 2 drinks, not 5. Nobody is saying the drink is bad. They are saying you have had enough of that one thing. Banks call it a concentration limit, and it exists so that one bad industry cannot take the whole bank down with it. A French bank called Crédit Agricole hit its own data center limit in July and started selling off a piece of a loan in Hong Kong. Morgan Stanley has been quietly asking other investors to take some of the risk off its books. These are not charities. They want this business. They are turning it away because they are full. So how full is full? Look at the size of the thing they are trying to finance. 4 companies, Amazon, Google, Microsoft, and Meta, have told their shareholders they plan to spend between $720 and $745 billion this year alone, building data centers in 1 year. That number is too big to feel, so let me put it next to something you can feel. Divide it across every household in America, and it comes to roughly $5,400 a house. That is a new roof. That is a year of groceries for a couple. That is what this one industry is spending per American home in 12 months. And they are not paying for it out of their checking accounts. For 5 years, these companies borrowed about $28 billion a year between them. Modest. Boring. Then in 2025, they borrowed $121 billion, 4 times as much. And in just the first 5 months of this year, $159 billion more. Meta did $30 billion of it in a single day last October. 6 different bonds, some of them not due for 40 years. Investors put in $125 billion in orders. They were fighting to get a piece. They are not fighting anymore. Back in February, these bond deals were getting about $5 of orders for every dollar offered. By July, that was under 2. Amazon came to market in July and had to pay extra to get its deal done. Bank of America's own analysts wrote it plainly. Investors are pushing back. Now, why does any of this reach your kitchen table? Because of how they built the deals. And this is the part where I have to tell you a story. Because I have seen this exact shape before, and it did not end well. In 2006, I walked into the mortgage business fresh out of car finance. In car finance, the rules were scripture. You put 5% down on the lower of the sale price or the appraisal. No cheating in either direction. My first week in mortgages, somebody sat me down and explained a loan called Pick a Pay. Advertise 1%, charge about 10, take the 9 points you did not collect and add them to what the borrower owes. And to justify the whole thing, use what the house was predicted to be worth later. I remember asking the guy, out loud in the room. You are letting them borrow the future value of the home? He said yes. He said it like I was slow. 2 years later, the lender who wrote most of those loans got bought for about $25 billion. And that loan book helped kill the buyer. Now, let me tell you how Meta financed its data center in Louisiana last October. Meta and an investment firm called Blue Owl set up a separate company to own the building. Blue Owl owns 80% of it. Meta owns 20. The project costs about $27 billion. Meta put in land and construction it had already paid for, and then took roughly $3 billion in cash back out of the deal. Read that again. Meta got paid, in cash, at the start of a project it says it needs. Then Meta signed a promise. If, 16 years from now, nobody wants to rent that building, Meta will make up part of the difference. That promise is worth about $28 billion, and it is not counted as debt on Meta's books. The bonds were sold privately. The single biggest buyer was a bond fund manager named PIMCO. You are letting them borrow the future value of the building. Same sentence, 20 years later, different building. Now, that loop I opened at the top. The bank said no. Who said yes? Moody's went looking and found $662 billion of data center rental promises across these 5 companies that have not even started yet and are not on any balance sheet you can read. Google alone disclosed 42.6 billion of them in one quarter, up from 23.9 the quarter before. It nearly doubled in 90 days. 662 billion is about $5,000 per American household, promised, on nobody's books. The Bank for International Settlements is the central bank for central banks, not a newsletter, not a guy on the internet. In March, they published a paper about this and gave it a name. They called it shadow borrowing. Their words, obligations that are economically akin to debt, but largely reside outside corporate balance sheets. And they said where the risk went. Private credit funds, insurance companies, pension funds. In January, 4 United States senators wrote to the Financial Stability Oversight Council asking for an investigation. Their letter names who is holding the bag, and I want you to hear the list in order. Banks, insurers, private credit funds, real estate trusts, pensions, retail investors, pensions. In a letter to the government, in writing, it is not a theory. Canada's National Pension Plan committed $2.4 billion with a partner to build data centers. New York City's teachers have $3.5 billion in digital infrastructure. California's teachers' pension chief said out loud that valuations are stretched and that he does not think it is a bubble yet is doing a lot of work in that sentence. That is who said yes. The banks handed the risk to the people whose job is to pay a retired teacher $4,000 a month for 30 years. If you want to see how tangled your own money is in all this, I built a screen where you can load your actual holdings and watch them priced next to the macro picture. That is the full package side of my macro command center at timtalksfinance.com/members, and the free side shows you the same live numbers I use. Now here is the second half, and it is the half that touches you directly whether you own a pension or not. 2 weeks ago, I told you your portfolio was one trade wearing 5 costumes. I did not have the number then. I have it now, and it is worse than I said. You have been told for 40 years that an index fund is how you stay safe. Spread out. Own everything. Do not pick. That advice was true when it was written. It is not true today. The 10 largest companies in the S&P 500 are now 42% of the whole thing. Nvidia alone is 7.5%. Strip out the 2 that are not really in this trade, and the artificial intelligence complex by itself is about 28% of the index. The long-run average for the top 10 is about 24%. The old record was 28%, set in 1970. We are past it, and it is not close. So if you have $500,000 in a broad index fund, about $210,000 of it is in 10 companies, and roughly $140,000 of that is one single wager on artificial intelligence paying off on schedule. You did not choose that. Nobody asked you. The index moved underneath you while you were doing everything you were told. And here is the part almost nobody says out loud. It is in your bond fund, too. Bond funds do not weight by company size. They weight by how much a company owes. So the more these firms borrow, the bigger their slice of your bond fund gets. Technology is now about 10% of the investment grade bond index. 5 companies that were not even on the list of America's biggest borrowers 3 years ago now sit alongside the 6 largest banks in the country. So the safe half of your portfolio is funding the risky half. If you are 68 years old and holding 60% stocks and 40% bonds, because that is what a careful person does, you are on both sides of the same bet, and you were never told. $47.6 trillion of American retirement money sits behind those 2 sentences. Spread across every household in the country, that is roughly $350,000 a home. That is the money on the table. Now, I want to be careful here because I am not telling you the machines will not work. They might work beautifully. I have no idea, and neither does anybody selling you a certainty. Here's the thing I do know, and it is the only thing that has ever mattered. Every single one of these things has a man who can make more of it. Meta can issue more bonds. It did 30 billion in a day and could do it again tomorrow. Nvidia is now backstopping the leftover value on some of these deals with its own paper, which means the company selling the chips is guaranteeing what the chips will be worth. That is a circle, and circles are how these things always end. And when it breaks, and something always breaks, the Federal Reserve prints the dollars that cover it. It did in 2008, it did in 2020. The men who ran the loans I sold against in 2006 did not eat that loss. You did, through the price of everything you bought for the next 15 years. Your house has a registry. Your bonds have an issuer. Your dollars have a printer. Your pension has a board of trustees who just bought data center debt because the yield looked nice. Every exit they are offering you has an owner. There is exactly one that does not. 21 million Bitcoin. Fixed. Forever. No board, no issuer, no committee that can vote at 3 in the morning to make more of it. Bitcoin is not a company. Bitcoin does not have a chief executive who can be pressured, or a treasury department that can be leaned on. There are no servers that somebody owns. There is a protocol, and the protocol says 21 million. That is the whole argument for Bitcoin, and it has never once changed since 2009. Not when Bitcoin was $3, and not when Bitcoin was 126,000. Every other thing in this story can be made in greater quantity by somebody who benefits from making more of it. Bitcoin cannot. That is the entire difference, and it is the only difference that has ever mattered to me. Now let me be honest with you about where Bitcoin actually is right now, including the parts that hurt. Because if I only gave you the good half, you should stop listening to me. Bitcoin is around $63,200 today. Bitcoin's high was $126,000 back in October of last year. So Bitcoin is down about 50% from that high and down 46% from a year ago. That is real. That is not a dip, and I am not going to call it one. The money is leaving too. The Bitcoin funds you can buy on the stock exchange have seen about $4.5 billion walk out the door this year. More than half of all trading days in 2026 have been days when more money left Bitcoin funds than came in. BlackRock's fund alone is down about 65,000 coins from where it peaked in the spring. And Michael Saylor's company, the loudest buyer of Bitcoin on Earth, actually sold Bitcoin in June and again in July. First real sales since 2022. I told you about their selling 2 weeks ago, and I am telling you again, because it has not stopped. They are underwater on the average coin they own. I am not going to hide any of that from you. Somebody in the comments would find it in 4 minutes anyway, and they would be right too. So here is what I see when I look at the whole picture instead of half of it. Every Bitcoin crash has been smaller than the one before it. Down 93%, then 84, then 83, then 77. This one, so far, 50. Each fall is shallower than the last one. That is what it looks like when something stops being a lottery ticket and starts being an asset. Bigger holders, steadier hands, less panic in the tank when the road gets rough. And every Bitcoin bottom has been higher than the bottom before it. $2, then 178, then 3,200, then 15,700. This time so far, 58,500. 4 cycles, 4 times, no exceptions. I want to correct something you may have heard about Bitcoin, including from people I like and read. The line going around is that each cycle's high becomes the next cycle's low. That is not true, and I checked it myself. In 2022, Bitcoin bottomed about 19% below the old 2017 high. This year, Bitcoin bottomed about 16% below the old 2021 high. If you repeat that line at a dinner table, somebody is going to pull out a phone and embarrass you. The real pattern is the one I gave you a second ago, and it is stronger anyway. Use the true one. One more piece of arithmetic, and then I will get out of your way. Every previous Bitcoin cycle put in its bottom about 12 to 13 months after the top. We are 10.5 months past the top right now. That does not mean the bottom is in. It means we are standing inside the window where it has always happened before. Probability, not prophecy. There are no certainties here. There never were, in anything. And while all of that has been going on, the rest of the world quietly finished building the plumbing for Bitcoin. Banks got permission to hold Bitcoin for their customers. The accounting rule that made it painful for them to do it got repealed. Bank of America told its own wealth clients in December that 1 to 4% in digital assets can be appropriate for them. The share of financial advisors putting clients into Bitcoin went from 22% to 32% in a single year. And the Bitcoin that has not moved in months just hit an all-time high, 16.6 million coins. That is about 83% of every Bitcoin that exists, sitting still in the hands of people who are not selling at these prices. Read those two facts next to each other, because together they say something neither one says alone. The money is leaving the funds, the plumbing is being finished, and the people who already hold Bitcoin are not letting go of it. That gap is the whole thing, and it is why I keep coming back to Bitcoin no matter which door the news opens that week. It does not stay open. So let me leave you with one number instead of a price target, because I do not do price targets, and I am not going to start now. There are about 66 million people on Earth with $1 million. There will only ever be 21 million Bitcoin. That is about a third of one coin for each of them. And that is before you take out the 4 million or so coins that are lost forever, and the 3 million sitting in funds, company treasuries, and government vaults that are not coming back to the market. At today's price, $100,000 buys you about 1.5 coins. Whatever you own of Bitcoin, you own it out of 21 million, and that denominator does not move. Your house has a registry that can be changed. Your dollars have a printer that never stops. Bitcoin has a number that was set before anybody knew what it would be worth, and nobody has ever been able to move it. I am not telling you to buy anything. I have never told you that, and I am not about to. I am one guy who did the arithmetic and is showing you the work. You are free to look at the same numbers and come to a different answer than I did. That is the whole point of doing it out loud. But I would ask you to do one thing this week. Open your retirement statement. Find whatever broad index fund is sitting in there. Look up its top 10 holdings. And then ask yourself, honestly, whether the word diversified still means what you thought it meant on the day you signed up. If you want help doing that, take the money quiz on my macro command center. It is free, no credit card, about 2 minutes. It shows you your net worth in one place, what inflation is quietly costing your cash each year in real dollars, and one move worth considering for your situation. That is at timtalksfinance.com/members. I built it because I got tired of watching people find this out 5 years too late. The banks looked at this trade and decided they had had enough of it. They just never told you they put it in your retirement instead.